Let's take a look at WiMi Hologram, and we're going to see if we can figure out the stock price for this company. The market cap is 200.8 million. It's a pretty small company, and the stock price is 340. So to get the shares outstanding, you just take the market cap divided by the stock price, and you get the shares outstanding of 59 million. And the way we calculate the stock price is we estimate the future free cash flows of a company, then discount that number back to today. And that will give you the value of the entire company. Then you take that number and divide it by the shares outstanding, the 59 million. Then you get an intrinsic stock price, and you compare it to the actual stock price and see if it's higher or lower. So let's get the actual cash flows. We'll go to the financial section of Yahoo, go to cash flow. They only have 3 years, so we'll just take the trailing 12 months also. It's the same as the 2019 number, but that's fine for the model. And next we need net income, which is the profit and loss for a given time period. That's on the income statement. And last we need is revenue, which is the sales for a given time period. So it looks like they're moving in the right direction. Sales have been going up. Net income has been going up a little bit. And free cash flow tends to be a little up and down, depending on if you have a large cash expenditure one year. So everything looks okay. There's no negatives. Makes it really hard to value a company with negatives. Let's figure out the capital structure so we know what to discount the cash flows by. An income statement is the interest this company pays on its debt. That's 11 million. Let's see how much debt they have. We'll go to liability section of the balance sheet. And the current debt is 71 million. That's due within 12 months. And the long-term debt is due after 12 months. That's 16 million. They do pay a high interest on their debt, probably because they're a small company, almost 13%. Interest payments are tax deductible, so let's get their effective tax rate. That might be hard with smaller companies because the income statement is not the best for looking at actual numbers because there's a lot of accrual accounting and non-cash items in here. Because you can see, like for instance, 2017, they had $74 million of income, but they paid $500 million in taxes. So obviously there was something passed through that year. So let's take the 2018 number. That's 97 million income and 8 million of taxes. It's still a low tax rate, but that's maybe just because they're so young. So the cost of debt is almost 12%, and they have 30% of the capital structure's debt, which isn't great, but it is a new. I think it's a newer company, or at least a younger company that recently IPO'd. So they may be taking on more debt. And then to get the cost of equity, we need the beta, but there's no beta in Yahoo. There's probably just not enough information. Let's put a 2 because it's probably more volatile than the average stock. So I think 2 would be appropriate. So the WACC is 16%, which is a really high discount rate. That means they have to profit at least 16% a year to add value to their customers or investors. So that's what we're going to discount the future cash flows by. And we estimated the future cash flows for 4 years. Then we did a terminal value. And it's not a big number, the terminal value, because that's all years beyond year 4. Just because the model takes into account how much debt a company has, the capital structure, and some other things. So the terminal value got reduced a lot. But it's better to be conservative than aggressive, especially when investing in stocks. So when we discount these numbers back to today's value, we get a $488 million value of the company. And when we divide it by 59 million shares, it's a stock price of $8, and it's trading at $340. So it is trading at a 59% discount, even with a conservative model. And you can see historically, it never really traded much higher than maybe 5.25. So it's always been trading at a discount. Like I said, it's really hard to model these smaller companies, 122 employees, and they're located in China. And I know that could be a concern for some people now investing in Chinese companies. But let's dive a little deeper, see if we could uncover any more information. So I have a few data points: earnings per share, PE ratio, and current ratio. Let's get the current ratio. We need to go to the balance sheet, and we need the current assets. Let's just open this up so we see if they give us more detail. So current assets of 177,511, and current liabilities is 122. So they do have a pretty good current ratio of 1.45. Let's just so the current ratio is current assets over current liabilities, and it's a good way to look at the liquidity of a business. And you generally want between 1.2 and 2. If they have below 1, that just means they don't have enough liquid assets to cover short-term liabilities. And current assets and current liabilities are within 12 months. So, for instance, current assets can be liquidated into cash within 12 months. Current liabilities is debt that needs to be paid within 12 months. It's either debt or accounts payable. It's what's owed to you. So you can't always look at one number and say, oh, great, they have 1.45. Okay, let's move on. You have to look a little deeper. You generally want to look at historical, because it might, one quarter could be 0.8 current ratio, which is really bad. Then the next quarter could be 2. So you have to look at it over longer term because some businesses are cyclical. But in this case, it looks to be good. And they don't provide as much data as if we looked at the 10K. But it looks like it's mostly cash to current assets. Because if you had a lot of inventory under your current assets, inventory isn't as easily converted to cash as cash is, of course. And the current liabilities list current debt, accounts receivable, that's the bulk of it, and then some other smaller things. So they look okay in that respect. Let's look at their earnings per share and their PE ratio. Because if you look in Yahoo Finance, they don't list that. They don't list the PE earnings per share because there's just not enough data to gather it, but we can easily calculate it. So earnings per share is net income over shares outstanding. And that's on our spreadsheet already. So net income of 102 million, shares outstanding of 59 million. So this isn't a hard number to look at because it's earnings for each share. So it's $1.73 earnings for every share they have. But each company has a different share price. So it's hard to relate that to things. So that's why people use PE ratio, because then it kind of puts everybody in the same category. This is price of the stock price over earnings per share. So this is generally you want a low PE ratio. So I look for companies under 15. Of course, there's companies like Tesla that have like PE ratios in the hundreds, but that's because they're growing so much. This has a PE ratio of 2, which looks really good. Just to explain the PE ratio, it's a PE of 2 means investors are paying $2 for $1 of profits, which is really good because it only takes you 2 years to get your investment back. So these numbers look okay, but it is a young company, and it's hard to look at just one number. But so far, everything looks good in terms of an investment. Now I'll leave it up to you to decide if you think this investment is worth doing. Because you have to remember, just because something is has good financials and they're doing well as a company doesn't mean other people feel the same way. Because the stock price is not based on how companies are doing. Of course, that really helps them. If their company's doing well, the stock price should go up. The stock price is based on how many people are buying the stock. It's not based on anything else. So if more people are buying the stock, the price will go up. Even if the stock is doing terrible, even like the company, I mean, is doing terrible, they're not making any money. And the price of a stock could go down if a company is doing really well financially, because people just don't buy it for some reason. So it's really based on how many people are willing to buy the stock. So it could take someone a decade or many, many years to figure out this company is worth buying, because they may not want to buy it because it's so small, and they want to hear other people buy it, or at least analysts talk about it, or hear it on TV. So you have to think of all these things when investing. So that's why investing should be a long-term thing, not a 1 week thing or a 1 month thing. It should be at minimum, I think, a year, but I think of stock investing as a decade or 2 decades. I buy for a long-term investment because I'm willing to ride the bumps. So let me know what you think about this stock, or if you want me to look at any other stocks. Thanks for watching.